Thanks for joining me on the webinar. I think there's a number of people on here. People are still coming on. So these are friends of my children, Fax, Eve, and Edward. And this idea came from my son, Fax, and I think maybe Catherine Breland. And I've been hosting webinars for the investment community, mainly our clients, our investors and friends and prospects and so forth. And they're fairly popular. I do economic policy analysis and I do economics lessons on these webinars. And I also write for Forbes, by the way. You can Google my name, Thomas Landstreet, and see a lot of my articles on the Federal Reserve, exciting things like tax policy, Federal Reserve policy. And the polls, actually, presidential polls, check it out. And then I will, today, what I want to do is just kind of go through how to invest and why. And that comes from one of my favorite books, How to Read and Why, by an English professor at Oxford named Harold Bloom. But a lot of kids ask me, well, Mr. Landstreet, how do you do this? How do you go about it? How do you start? So I thought I'd go through the simple way to start and basically grow rich through investing. And then I'm going to go through how not to invest. And I'm going to go through a few things regarding Social Security, which is going to basically let you down. And then I'm going to go through the current economic picture and where I think the opportunity is or isn't in the market. And I will tell you, I've had a long career on Wall Street. My whole career, I've been in sales and trading and research, capital markets management for an investment bank. And then my crowning achievement is I got to work for the great Arthur Laffer, PhD, the economist who convinced Ronald Reagan to cut tax rates from 71%, 71% tax rates. You kept 39 29, sorry, 29 cents of every dollar you earned in that tax regime. He convinced Ronald Reagan to cut tax rates from 71 to 28%, which set off a 20-year bull market. So I got to work with that guy, and it was absolutely awesome. What I learned from that is that there are a lot of things that drive value in the economy and in the market, but none bigger than government. Government is the 800-pound gorilla in every city, state, industry, country, defining incentives, positive and negative, and economic participants. Those are just people that run businesses and manage businesses, own businesses. They respond to incentives, again, positive and negative. The government's the 800-pound gorilla. And so there are a lot of unintended consequences to policy. So we keep a sharp eye on policies when we make our investments. I run a hedge fund now, by the way, which means I am a long, short, global macro hedge fund. I focus on, again, government economic policies for a lot of my ideas. And I'm about 30% short right now, which means that 30% of my portfolio is short, which means I'm expecting the equities that I own to go down in price. And it's very exciting. We also have a wealth management business. We help families and endowments, foundations manage their overall pie, if you will. I'd say preserve their wealth and grow it. And then we have another couple of products. We're just entrepreneurs, and I'm having a great time because, I've got a long history in this business, and it's just a blast being able to apply my craft and be tested every day by the markets. Anyway, that's me. You're seeing that picture. And then here, I want to go over COVID and the changes it has wrought on our economy. And personally, you can see some of the interesting, I don't know if you can see my video. I don't think you can. You should be able to see me, but I don't know that you can. Anyway, so online alcohol sales have rallied. Overall alcohol sales are at record levels, and that's exhibited by my own personal behavior. Every afternoon, the cocktail hour becomes much more important each COVID day. And I'm gonna tell you what we've been doing during the quarantine to occupy ourselves, and during the lockdown and everything. There we are. So that was day 4, actually. And we were just, having kicks around the house, if you will, trying to occupy ourselves and enjoy ourselves during the COVID crisis early on. Okay, enough of the silliness. I am going to start the presentation here. So this is just about saving. Who wants to be a millionaire? All you have to do is when you start from zero, is start investing monthly, some amount, $50, $100, $200, $400, make it hurt a little. You'll never miss the money. And if you do that so that every month you sock that away in a Fidelity account or TD Ameritrade or any of them, you'll wake up one day a millionaire. And it starts like, look at this. If you invest $425 every month for the next 40 years, $1 million right there. You won't miss it. You'll wake up one day and you'll have doubled your money. You'll wake up one day and you've doubled it again. And it's more about the periodic saving, meaning the monthly saving, than it is about the compounding and the investing well. And it's the starting early. It makes all the difference in the world. Starting early is like the ticket. And I don't think people talk about that. They talk about investing in stocks that go up and Apple or Microsoft or Netflix, but do they ever talk about the real way to get rich, which is just start young and do it every month without fail? Compounding interest, a beautiful concept. You can see interest paid on accumulated interest. It grows every year. Every year you have a little bit bigger pie to grow the interest off of. So if you invest $100 with a 7% return, compounding means that $7 extra return also gets reinvested at 7% the next period. And then the following, it's bigger. And so it only takes 10 years to double your initial investment and only 7 more to do it again. Think about that. So that just happens with your $425 a month. You'll be doubling it in 10 years, that $425. Okay. Anyway, so you get the idea. How can coffee make you rich? You can speculate in the futures market like I do. Or how about not spending $4.50 a day on a Starbucks coffee? 40 years later, if you put that into the market, $323,000. So there you go. Sensitivity analysis at its most precise. Social Security. Few people realize it's insolvent. It was started in 1935 under Franklin Delano Roosevelt. Before that, people saved for their own retirement, themselves. Anyway, it was signed into law. The retirement age was 65. Life expectancy was about 60 years old. They earned $400 a month in today's dollars. And now Social Security is the biggest government program on earth. The life expectancy is now 78. Retirees collect $1,500 a month. So because of the baby boomers retiring, by the way, I'm 1 year shy baby boomer. A lot of your parents might be baby boomers. We're retiring. It's so such a disproportionately large group of humans that we're going to be tapping into the Social Security fund. It's our money. You can't have it, kids. Good luck, because it's a disaster waiting to happen. There's a deficit of $43 trillion. So the liabilities minus the assets leaves a $43 trillion deficit. You can see the liabilities at $176 trillion. I remember when trillion was an insane concept, insane word. You never used it, but now it's routine. And I'll show you charts that prove it. Social Security assets, $3 trillion trust fund plus the current payroll and future payroll taxes expected to come in based on some economic assumptions. That's $133 trillion. The deficit is the difference. And so the idea, I think, that Social Security either won't exist, and I wish it didn't. I wish you could do it yourself privately. Or Congress will legislate some of the following. Higher payroll taxes, I think they're inevitable. Lower monthly income for retirees, which is maybe inevitable. And then increasing the eligible retirement age, which they should do right now. It's currently at 65. The average age is 78. They should raise it to 68. And the whole, by the way, the whole actuarial table changes. In other words, it almost becomes solvent with like a 3-year change in the retirement age, just to let you know. It's not that hard, but there's no political will to do it. Our Washington elites, our politicians they fail us, and that's about all they do. And remember, I study government economic policies for a living, okay? Everything. And I'm going to go through a little of it. So I have a front row seat to the train wreck that is government policies, okay? And they never end up pretty. And the more ambitious, the more disruptive, okay? So anyway, we'll get into that. I know you can hardly wait. How do you save? Well, Roth IRAs and traditional IRAs are terrific vehicles, obviously, because you put in pre-tax dollars. But if you have a 401k, you simply max it out. 401ks have a limited selection of mutual funds and ETFs, but you got to live with it because the value of the 401k is so great. If you don't have a 401k, or you can add something to it, do a Roth or a traditional IRA, you can add up to $6,000 a year, and I would max it out. And then and the compounding effect takes over. One thing I will tell you, current market, the valuations are unprecedented. The only time we've seen, couple of times we've ever seen with these valuation levels, which is companies whose stocks are trading at a multiple of earnings or revenues. The only time we've seen it rival this is in 1999, before the big internet bubble. You guys were just little babies, if at all, if you exist at all. And it was something that we adults will never ever forget. The bubble was popped in spectacular, bloody fashion, and we're there. I feel like we're there. So this is a market wrought with risk. If you ask me, buying Google, Amazon right here, right now is probably insane. Commodity and precious metals, mining companies. I'm going to kind of go through some of the values out there, and then gold, which I'm enamored with, and we have a large position in our portfolio. I advocate you put a little into gold, and I'll tell you how to do it. Here's how not to invest. Have you heard of this guy, Dave Portnoy of Barstool Sports? He has become quite an icon and an outspoken promoter of stocks. And Portnoy, you've heard of Robinhood, right? Robinhood is a free trading platform that was founded very recently. It does not, they don't charge you for your trades at all. You probably know this. They'll give you a free share for signing up, a free share of something, a stock. And you can go speculate on that one share and parlay that into a fortune, okay? On Robinhood. I'm sure you've encountered Robinhood. It is absolutely, to me, this is the symbol of excess, okay, in the market. When I said Amazon and Google have these lofty valuations, another sign that we're in a bubble is Robinhood. I've been making a lot of money, kids, shorting Robinhood stocks every day. I have a system where I go through to see what stocks these young people are on. And then I have this method for determining when they're going to collapse, and I short them. And I've been making money almost every day in my portfolio, picking off uneducated speculators, led by the Pied Piper himself, Dave Portnoy. There he is. I'm sure you know about him. I do not advocate that you follow him, but he is worth checking out. This is how not to invest. Oh, and he's made his fame has taken him all the way to the White House to visit with the promoter-in-chief, Donald Trump, who, by the way, I'll go through my opinion of that too. All right, so here it is. Here's how not to invest. This is Portnoy's quote: get some letters in your portfolio and watch them go up. It's that simple. Letters, those are ticker symbols for stocks, for companies. He doesn't know what he owns. He doesn't know the name of the company. He doesn't know the balance sheet, the income statement. He doesn't know their revenue growth. He doesn't know management. He doesn't know the marketplace. This is not investing. They've got these, I call them Pied Pipers, these leaders, these influencers on Twitter and Instagram, Reddit, and TikTok. There are 5 of them with well over 100,000 followers each, 30 influencers with over 10,000, and then hundreds of thousands of people in the chorus that retweet and like and retweet and like. So every day and night, these people come out with their tickers. Remember, these aren't companies, these are tickers, letters in your portfolio, and they'll blurt them out there. And then there's this ripple effect, right? And the stocks go up, and I'm talking 10, 20, 30, 40, 50, hundreds of percent in a day or two. And by the way, back down. Wait till you see this. Portnoy, he's a fashionable dresser. I've been staring at this picture, and the kids are not going to like me for this, but I am going rogue. I'm going to get that outfit and start wearing it. Okay. And I don't care what people say. I'm mid-50s. I could do it. All right, there you go. Quote: I used to dread up at waking up at 7 a.m. I used to dread waking up at 7 a.m. for work. Now I'm up before 6, ready to trade stocks. Now you know it's a speculative frenzy when young people want to get up at 6 a.m. ready to do anything. Tomorrow, the bottom one is Juneteenth Day. So on Juneteenth, an army of speculators jumped into African-American owned companies, many of which were practically worthless. Did I short them? Yes, I did. Did I make a fortune? No, but I made a lot of money. I'm going into the next one here. Now, this is the best one. Grin is a cryptocurrency, okay? It's like Bitcoin and Ethereum. So Grin is a new cryptocurrency, the private and lightweight Mimblewimble blockchain. One of these influencers got on Grin, okay? A couple of them. Grin is coming. There's nothing anybody can do to stop it. And then this guy tweets, Grin, so many scared hands. This will go up from here. Relax, have a drink, buy some crypto. So they start promoting this cryptocurrency on Twitter and other platforms. The hoodlums, the Robin Hoodies, the legions of witless, brainless goofballs who weren't in school and started gambling in the stock market, bought the wrong Grin. They bought Grin to Rod shipping. This is a dry bulk shipper, meaning they ship goods, not oil, not liquids, but dry bulk from China mostly, right? If you see this chart here, I don't know if you can see my cursor, but it was bouncing along between 3 and 3.25 for a very long time. In fact, years. These guys that thought they were buying a cryptocurrency bought Grin, Grin, the ticker. Remember, they're just letters. Get them in your portfolio. Of this dry bulk shipper, whose business, by the way, is in very bad shape, huge debt, terrible secular fundamentals in their industry. Trade's been crushed. Look at this thing, goes from 3 to that price would be 7 or $8, right? And then the Robin Hoodies figured out that they bought the wrong Grin. They bought a stock, not a Bitcoin or proxy for Bitcoin, not a cryptocurrency. And the stock goes right back down from about whatever that is. I think it might be 7, 8, back down to 350. And we shorted that and made money on it, FYI. So just to recap, some of these leaders start talking about Grin, a cryptocurrency, which is not traded on the indexes, is not traded in the stock market, okay? You have to go open up an account at a crypto vendor and get a wallet and all that, a totally different process. And they run out and buy a stock that was practically worthless, bid it up 300 and something %, and then realize they bought the wrong stock and it goes back down. Here's why I'm telling you, just stay away from Robinhood. Do not do this. Thank you. And if you need to talk to me further about this, you know where I live, on Tyne Boulevard in Chancery. All right, we're going to go through an economic snapshot real quick, okay? And I'm going to go through my framework for investing and thinking about the economy and markets. And this is what Arthur Laffer calls the 4 grand kingdoms of macroeconomics. And this is where all government policy is expressed through one of these 4 grand kingdoms. By the way, N3L is my hedge fund. Trustco is my wealth management business. N3L stands for Newton's third law, which is for every action, there's an equal and opposite reaction, right? Government policy, economic reaction, disruption. Policies change behavior. Legacy companies are disrupted. New companies emerge based on the rule change driven by government policy, fiat. You with me? Fiscal, this is the big grand kingdom. This is tax rates, tax credits, subsidies, okay? Bonus depreciation rules. We have an accountant or two out there. You may know what those are. Policy changes, tax policy changes. And taxes were cut in 2016 under Donald Trump. So let me tell you about politics, because again, I study policy. Policy and politics are inextricably linked. I am not partisan, but I am political only because it's policy, right? My maxim is this, and I hope you never forget I say it. Neither party has a monopoly on bad ideas. I'm older than you, and my father used to just pontificate about this. Republicans and Democrats have a lousy record through history. I can pick on every one of them, including George Bush, who I like as a person, okay? But not a great president, I promise you. Richard Nixon, Republican, terrible president. John F. Kennedy, Democrat, good president. Bill Clinton, lousy human. Oh my Lord, what a lech. Good president. Morality is not a prerequisite for good governance. I found this out the hard way. Trump is a lousy human, but you know what? His policies are darn good. Watch this. Tax Cuts and Jobs Act enacted in 2016, cutting tax rates, corporate. Trickle-down economics, where the companies that got this tax cut did something with the savings, and I'm going to go through it. It literally narrowed the wealth gap, which is all we hear about now, right? racism and the wealth gap, right? The disparity between rich and poor. I'm going to go through some of this. After the tax cut of 2016, hourly earnings increased over 4% a year, a record over the last 35 years, the best in 35 years, gang. And that is from the tax cut, because when I got my tax cut, I run a business, and when other people got a tax cut, they had to start competing for employees then, because other companies got an increase in their profitability, which they were willing to invest in growth, which means people often, and they would come raid other companies of their good employees, and those companies had to actually raise their wages to compete for employees. It's called free market competition. Okay, we don't see much of it here in the US anymore, but it works, and that tax cut literally led to higher wages. And guess what? For the lowest cohort, all you hear about is the rich getting richer, right? But look at this one. The median annual wage growth up to March 2019. A little stale, that's true. Up until COVID, this was like the thing. Here we are. Pay level, the lowest 25%, the lowest quartile of wage earner, garnered the greatest gains from the tax cuts. You can see that they had a well over 4% wage growth. Okay. And then the second cohorts, that next gray bar, got a 3%. And then the third, 3.5, and the top 25, 3% increase in wages. That says it all, gang. Tax cuts are accretive, not only to those who pay the taxes, the wealthy, but those who work for a wage. Oh, by the way, that's the Laffer curve. Go look it up. The Laffer curve studies the dynamic effect of tax rates on behavior. If you lower my tax burden, I will produce more. In so doing, I pay more in taxes. There's like an accretive effect from me making more and paying more. Making more, paying more. Cut the friction, cut the burden. I'm free to move. I'm free to invest. I'm free to grow. I'm free to hire you young people, and let's rock. And then we end up getting our revenues up, and our tax receipts end up going up. It's a dynamic effect of tax rates on behavior. It's the Laffer curve. Now, regulatory. This is like everything else besides fiscal, monetary, and trade, the other grand kingdoms. Regulatory is regulations and restrictions. Trump has been a deregulation president. He has enacted fewer costly regulations than the past two presidents, including George W. Bush. You can see here, this is significant regulatory actions have an annual effect on the economy of $100 million or more. These are actions that have an annual effect of $100 million or more. These are ambitious regulatory initiatives enacted during a president's tenure. Bush did 465 of these greater than $100 million regulations. Obama, we call him, well, we jokingly say he was on a regulatory jihad. He was trying to regulate everything, almost to death. That's what the Democrats do. The Republicans do it too. Democrats in this one, they're even worse. But look at Bush. He's no better. That was terrible. He passed the ethanol mandate, which is insanity. I could do a whole webinar on that one. Trump, 229. So again, he's a deregulator. He actually believes in less government. I do too. Remember, I've got a train wreck I've got a front row seat to the train wreck that is government policy. So over the time, I've become a little skeptical of government, and especially ambitious government policies. Federal deregulation has saved at least $23 billion here, coming from HHS, Health and Human Services, Labor, Department, Interior, Transportation. That's a lot, gang, annually. Trade, another grand kingdom, the most underappreciated. Tariffs and subsidies for trade. Boy, I have found through my studies, trade is like totally encumbered. We don't have free trade. I mean, there are regulations and restrictions on every single commodity, for instance, especially oil and food. So Trump's tariffs on China, I see both sides. I'm a free trader. I'm a free market supply side economic analyst. I think the government disrupts more than they create value. And so let me say, you probably got that already. As a free trader, I was very upset to see these tariffs. However, I have a very good friend of mine who's a president of Salesforce, ticker CRM, the cloud behemoth, a very important person. a Democrat, very good friend. All of Silicon Valley agrees with Trump's trade policy on China. They said we've been ripped off of all of our patents, and it's been very difficult. So strange how he was on that one. Nobody else would have had the guts to do it, like it or not. He did it, and the Democrats like it. Very interesting. It's the only policy he's come out with that the Democrats and Republicans agree on. However, it's basically cut the gains from the tax cut. So the tariffs threaten nearly 40% of the projected Tax Cut and Jobs Act GDP gains. These are, GDP's gross domestic product, the economy, the gains, the growth that we got from the tax cuts has been obviously cut back by the tariffs. So like it or not, that's where we were in the economy before COVID. And then monetary. Now this is edgy stuff right here. This economy and this stock market is totally being manipulated. That's a new word in my vernacular. I would have said affected by the Federal Reserve, money printing. Now I say manipulated. I scaled up my rhetoric because it's true. So we have unprecedented global central bank activity. This is going to be exciting for you. Here we are. This is the bull market since the 2009 crash. You see ZIRP, zero interest rate policy. Fed funds, this is the overnight rate that the Fed lends to banks. Overnight rate. It's the cheapest, most plentiful money in the world by far. Zero interest rates on that money meant ZIRP. That was a very, dovish Fed policy, never been done before. They lower the cost of money. They push money into the system by lowering the interest rate, the friction. Then they enacted Operation Twist, where the Federal Reserve actually started trading good assets for bad assets with banks like JP Morgan, Wells Fargo, the big ones. I won't go through that. Troubled assets were, of course, I will go through a little. They were all those mortgage-backed securities that went bust during the housing crisis of 2008. I'm sure you've read about it. It was gruesome. And all these banks were choking on this bad debt that was not going to be collected, that was going into mammoth default. That was the whole purpose for the meltdown. Here comes the Fed with newly printed dollars, okay? They print money, and they come in and they buy those stinky assets off the bank balance sheets and put dollars in there and then hold the stinky assets. Anyway, another unprecedented policy. Look what it did to the market. The twist came right in that dip. So every time the market goes down, the Fed responds with a policy change. QE 1, 2, and 3 under Janet Yellen, they started stepping in and buying treasury bonds. They, the Fed, remember, with newly printed money, okay? This money was not in circulation. They dilute the value of each dollar every time they print a new dollar. You understand that? They start QE1, quantitative easing. They print new money and go to Wells Fargo, go to JP Morgan, and buy treasuries off their balance sheets, injecting money into the system, hoping they'll lend that money to the animals out there like me that want to start a business, and companies that are, taking on debt to grow their business. Here's the Yellen pause. That was in the gruesome and scary winter of 2016 when the market swooned. It was brutal for us in the market. She had reversed the easy money policies. She raised interest rates one time. Remember ZIRP, zero interest rate policy? She was the first Fed chairman to raise interest rates, okay? Remember that increases the cost of money on the wholesale level. She did 1/4 basis point, okay? Nothing, and the market gapped down violently twice, and then she did the Yellen pause. She backed off and said, sorry, gang, just kidding. We're gonna stop right here. We're not gonna raise rates anymore, I promise. Then the market rallies. Thank you, easy money again. And then the market starts taking off. Surprisingly, GDP growth, gang, GDP meaning, the growth of our economy was at 1%, maybe 2% at the most. In other words, way subpar, barely above inflation, moribund at best. Despite that, the market rallied 300%. Why the Fed? The easy money. Okay, Yellen pause. Then you get this guy named Jerome Powell, our current central bank head. He comes in and says, okay, we're going to raise rates, finally. And he does this rate increases are on autopilot speech. That was October of 2018. And the market, guess what it did? Collapsed. And then he backed off. The Powell pivot, the famous Powell pivot. It was Christmas Eve of 2019, the market was down like 10% that day. I'm around here with my family trying to have a nice day. Market was open. Okay, it was a trading day. And I was about to run out and throw up all day long. It was brutal. And then Powell pivoted. In other words, he did what Yellen did. He said, I'm kidding, joking, gang. We're not going to raise rates. We're going to reverse ourselves, which he did. Look what the market did. Rallied strongly. Then he had to cut rates because the market was showing jitters. There was something called a repo crisis. Liquidity was drying up in the system. And he had to actually reverse the 2 rate increases. So we're back to zero again. The point is this, they went easy. They went on 0 interest rates. They injected all this new money in the system. They created an animal that they cannot now slay. And then you see this swooning market, the March COVID crisis, and they jumped in and they did something they've never done. The Fed again started buying corporate debt directly. By the way, of companies like Marriott took on $40 billion of fresh debt to buy Starwood Lodging at the highest price ever paid per room for a hotel chain. They paid it. And they took on $40 billion of debt to do it, new debt. By the way, at almost 0 interest rates. Remember, 0 interest rate policy. Money's free, money's plentiful. Let's do this acquisition at the top, paying, a record amount of, and then here we go into the COVID crisis and nobody wants to stay in a hotel. And guess what they do? They come to the Fed for a bailout and the government bought $150 billion of Marriott bonds. Let me tell you something. The CEO of Marriott who bought Starwood and paid the highest price for it was also buying back stock feverishly using debt. And their compensation, executive compensation package, was built on buying back stock returns. So they could borrow money freely, make a ill-advised acquisition, buy back their own stock at records, pay themselves a lot of money. It was an orgy of debt and spending in excess. And then boom, here comes the COVID crisis. And the Fed steps in and starts buying that debt, corporate debt, never been done, gang. They had to go around the law to do it. They set up what they call special purpose vehicles, SPVs. The Fed took newly printed money, injected the money in these SPVs, and the Treasury went and bought this debt. They bailed out companies that were irresponsibly run with your money, diluting the value of every dollar. I'm fixated on this. This is going to be the defining policy of your life. I swear to you. It's something you're going to, for the next 10 years, because you paid attention to this webinar, you're going to be paying attention to, because it's going to be wild. And I'll do some follow-up webinars. So look at this. This is the Fed balance sheet, okay? So here we are. It's got to go to 20 trillion. It's currently at about $8 trillion balance sheet. Remember, the Federal Reserve is buying Treasury debt from banks and injecting new money into the system. The Treasury funds the daily operations of the federal government, Treasury. Okay, they issue Treasury bonds to raise money to pay for government services, which are in $3 trillion in deficit per annum now. So they got to sell $3 trillion in new debt just to cover the expenses of the current government operations. Are you with me? That $3 trillion per annum of new debt is overwhelming the capacity, the demand for that Treasury debt, especially at interest rates of 0.6%, 10-year Treasury debt, the lowest ever. Nobody wants to buy it. So the Fed's buying it with newly created money. And this expands their balance sheet. It's mind-boggling, gang. Trust me, we're going to go through a few more. This is money supply. This is dollars out in the circulation. This is the Fed's balance sheet going back to 2016. If I showed you this from 1920, the chart looks just that even. Little bips and little wiggles. Not much going on until 2020. Boom. That's the Fed. That's money. That's money in circulation. Here's the market value of Treasury debt. This is the amount of Treasury bonds that have now been issued into the market to fund the deficit spending for the government. If this chart was anything, I would be panicking. If it was the number of oranges in the world, I'd go, what? What is that? Free markets never produce charts like this. Supply and demand equilibrate. This has to be whatever it is. This has to be the subject of the result of government policy. because these charts literally don't happen in free markets. Another webinar. Whoa, gang, check this out. Negative yields. Did you realize that there's $16 trillion worth of sovereign debt, which is, remember, US treasuries are sovereign debt, sovereigns of countries, the ECB, European Central Bank debt, and the Bank of Japan debt that are yielding negative interest rates. So pensioners in Germany have to put their money into something safe and liquid, which would be European Central Bank debt, like our treasury debt. It's bonds that yield them, that take money from them. They give them $1 or €1 and they get actually like 91 pence back. You in for that? Is that a good deal, gang? You love that? Isn't that neat? That again wouldn't happen in a free market. This is manipulated and it's sick. What do those pensioners do? Negative return. And they're forced to own that treasury, those treasury paper, by the way. They can't buy Amazon. They actually have to own that crap. It's worse. It's riskier than Amazon. That's why Amazon's price has gone up so much. Sovereign debt is now riskier than stocks with huge cash flow and cash hoard like Apple. There's your answer to the bubble. Problem with the bubble is it's still a bubble. These companies are better than freaking government debt. That's true. I'll agree. Well, look at this one. Here's the U.S. government debt is expected to exceed the size of the economy for next year. This is your country, gang. You're a little younger than I am. This is some edgy stuff, if you ask me. That's debt. That is just a sign that they're going to have to issue all that debt, and the Fed's going to have to buy it because there's no buyers. Look at this one. It's all short-term debt too, by the way. This is like having a mortgage on your house that's not a 30-year mortgage where you amortize your payments over 30 years. It's 5. And then at the end of 5 years, you actually owe the remainder of what you hadn't paid. And so it's called like a balloon payment. This is how much the federal government has to refinance every year for the next 5 years. Oh, and corporate debt is no better. Look at this one. Coming into the COVID crisis, 60% of NASDAQ companies had junk bond rated debt, a record by far. So the debt that I talked about coming from easy money, right? Zero interest rate, ZIRP, twist, quantitative easing, those money injections, all they did was inflate a debt bubble that not only is at the federal level with the $3 trillion deficit I just mentioned, but at the corporate level. 60% of NASDAQ companies have junk bond rated debt, by the way. Junk is junk, gang. Meaning it's not good. It's money. It's risky. If we have a meltdown, this would blow up and there would be arms and legs and body parts everywhere. And that's why the Fed is doing what they do every time they're coming in to bail it out. They have to. If they don't, we blow up. So our economy and our well-being is in the hands of the 800 egghead PhDs at the Fed. They employ 800 PhDs. Whoa, since the COVID crisis, money-losing companies have outperformed profitable companies significantly. Why? Why would that be? After the COVID crisis, after the economic meltdown, you'd think investors would get more picky, not less. You would think investors would be more discriminating and only buy the good companies. Wrong. It's because these companies, the debt-laden companies, were the ones that were down the most. And when the Fed provided a lifeline with their newly printed money, the bailout, it was the patient that needed the oxygen the most that had the strongest comeback, right? There you are. This is twisted stuff, gang. It's weird. As an investor, this is hard to navigate. I look for value. Speaking of value of U.S. investment grade corporate bond deals in August, a record. So this is more of the same, more debt, gang, more debt being issued post-COVID. Debt upon debt upon debt upon debt upon debt upon debt. Chapter 11 bankruptcy filings usually happen 6 to 8 or 9 months after a recession. We've just come through a recession. Bankruptcies will pick up. We'll see them in the next month or two. They'll be going all the way through halfway through 2021. We have not seen the worst yet. Covenant light loans. Back to the corporate debt bubble. Remember I said 60% of NASDAQ companies have junk bond debt? Guess what? A record amount of covenant light loans have been issued. That's if you people and I ran a company and we issued debt. Money is so free and so easy that we don't even have to put in covenants, meaning that the lender has little recourse in case of a default. The lender, not the borrower. The lender has little recourse. So if something goes wrong, they're screwed. The banks are screwed. Screwed. This is just part of the debt bubble. This is what worries me. Covenant light loans. The borrowers, the big banks, the Fed, have no recourse in case of trouble. Banks' ownership of treasuries. Remember, the Fed's got to, the Treasury's got to issue all these treasury bonds to fund the annual budget and the spending. Banks are forced to own them. The money center banks, of which there's like 20, they get a lot of privileges for being money center banks. A lot of them, like free money, but they have an obligation. They have to buy, whether they like it or not, treasuries at the auction. So we have these weekly auctions that are huge and growing and unprecedented and at record levels, where the Treasury is selling that Treasury debt I told you about to fund the government spending. And banks are forced to buy it. And guess what? It means that their cash is ironically falling. So despite all the federal government, money printing, you could call it, cash on their balance sheets is falling. This has the makings of a credit crisis. No lie. A credit crisis amidst the greatest increase in credit in history. Corporate equities and profits. The blue line is the stock market. The red line is corporate profits. Not in my lifetime have we seen a bigger gulf between the value of the market and corporate profits. So this is where I see some value in the market. The red line is the S&P. The black line is value stocks. Remember, 5 or 6 stocks, Amazon, Apple, the FANGs, they represented almost 40% of the S&P's move this year, 40% from 5 stocks. So in other words, the concentration of performance is like I've never seen it before like this. And what they call the dispersion of returns, very unhealthy. This is not a broad market. It's bubble market material. And value stocks have gotten crushed. Those are just stocks that aren't Amazon, literally, that have a lot of cash, say, on the balance sheet. They don't have a lot of debt. They might have slow growth businesses. Maybe they're commodity producers, but they are at historic lows. And in my hedge fund, we're nibbling at these. We're buying these because I know that if you do have a dislocation or disruption and the high growth, high multiple stocks blow up, then I'm going to have a good trade here. This is gold. I'm really into this. Why? All the money printing. Remember, we went through that. They're diluting the value of the dollar by printing more money. And by the way, they're just getting started. If the Democrats win the presidency, they're going to embark on something called modern monetary theory, MMT. Modern monetary theory suggests that there's no consequences to endless money printing. There are no consequences to it, right? Let's put the word inflation aside here and assume that there's no consequences. What it means is they could send every American a check for something other than work effort, okay? Universal basic income. Now that's a tremendous disincentive to work, by the way, so our productivity would go through the floor. Surprise. You have to have productivity growth and economic growth to fund the government and all the shit they want to spend money on. So if they go and they send everybody a $20,000 check for nothing, for something other than work effort, productivity declines, people can quit their jobs and don't care, economy goes in the toilet, deficits soar. There's one consequence. The other one is they'll dilute the value of the dollar so aggressively we'll have inflation like we've never had in history. So that's why I'm looking at gold, GLD, which is a spider gold shares. I recommend you guys take a little position in gold. It's going to be the best trade of the year. Watch. Remember I said it. If I'm right, I want the kudos. If I'm wrong, I don't want to hear a thing. Printing money means higher prices. You dilute the value of the dollar by increasing the amount of dollars in the system. This just shows what money printing over the years has done since 1975 when we went off the gold standard. Richard Nixon took us off the gold standard. Prices were extraordinarily stable, you can see, until they took off. They took off because the dollar was once pegged to the gold, and gold supply only rises at like 2 or 3% a year, no matter how much they mine it, and it holds its value. It's a worldwide currency that's got more validity than paper currencies. And when they decoupled, look what happened. The value of the dollar declined. And that's what I think we're going to see, a significant decline in the purchasing power of the dollar during your lifetime. And we might see legendary inflation emerge. Conclusion, max out your traditional and Roth IRAs. You got that? The compounding effect is your friend. Operate with skepticism regarding Social Security and all other government programs, entitlement programs, and vote accordingly. Vote for smaller government. It's your only hope. I'm sorry we're leaving you with all this debt. I'm not involved. Don't blame me. I've been a critic of it, and I remain a vocal critic of it, and I will continue to criticize it. Diversify your holdings. Value stocks, maybe a little gold here. Do not get into Robin Hoodies ever. And there's a lot of research you can do on mutual funds to find out the best performing mutual funds and so forth. So we're at the end here, and I'm proud to entertain questions if I can just figure out how to get to the Q&A. All right, ask me some questions. You do it in the chat. And I, unfortunately, am adult. Oh, and I'm going to do another webinar, by the way. So stay tuned. And I'm going to go through some more stuff on investing in the economy if you're interested. And I only touched on certain things today, but there's a lot more there if you're interested. I find it fascinating. Few other people do. I'll tell a little joke while I wait on Q&A, and I'll try to figure out how to open it. If you were starting with $100 a week right now, what would you allocate it to? That's a great question. I guess I would go with mutual funds unless you're a stock picker. I would just put it into a mix of mutual funds. You can easily find out the best performing mutual funds. Okay, Morningstar has the data. There's lots of ways. These days you can get everything. Okay, I don't know if I'd buy like the S&P or the NASDAQ triple Qs, one of these ETFs right here. I worry about this market. Of course, watch it be the bad advice. But I think I'd be a little cautious and buy dips on those, on the high flyers. And you can get, I think, value. Find the best performing value stock manager mutual fund that you can find and put some in there. You can allocate a little bit to gold. I would do it. GDXJ is an ETF. And, I would, of course, remember, I'm a contrarian. And hang on, and so that's what I would do. You can, and I will help you if you want to reach out to Facts. I'll be glad to help anyone who wants to like explore any part of this conversation, or with me, I'll do it. It's the least I can do. Okay. Why is the Fed issuing so much debt with short tenor? Is that the right tenure? No, what? Why not spread maturities out across the curve? Here's why: it's cheaper. Short-term money is so much cheaper. Bill Clinton, we used to have, that's a great question, by the way. Our debt, the government, federal government debt, used to be equally spread over many years, 10, 20, 30 years, right? Bill Clinton, to save money on interest, shortened our yield, our what they call it, the term structure of our debt to like 6 years. So all that debt that was piled into 30 years got squished into this big pile that's all coming due because the interest payment on debt is so much lower short-term than long-term. And that's it. It's cheaper. Can you believe it? So now they put us at risk because we got all this debt that has to be refinanced today and tomorrow and the next day and the next month and year. They've got to refinance almost $1.5 trillion of debt by January 1, 2020. That means they have to issue that debt. They have to, and the banks have to buy it. And the banks don't want it. They're up to their gills in this stuff, and it pays nothing. Who's going to buy it? Not you, not your dad and mom, unless they have to. All right, that was a great question. More questions. What assets do you like in the event inflation takes place? Gold and silver, precious metals, and I love the miners. The cheapest gold in the world is in the ground. Look at the chart, hit gold, go to bar chart, go to the commodities, hit gold and silver. Look at those charts. Almost $2,000 a ounce, almost a record in modern times, okay? So the bullion, the bars, gold, spot price, at a record or near a record. And the miners, they all have about a $900 or $950 per ounce cost. So it's traded at $2,000. They can get it out of the ground for $950, all sustaining costs, by the way, of production. And they keep the rest. It's cash flow. The miners, these companies are the only companies in the whole market that are raising their dividends today. Did you know a record number of companies have cut or suspended their dividends this year? Duh, COVID. Not in the mining space. Just had one. Grand Columbia raised their just established a 2.9% dividend. Why? Excess cash flows. It's the only sector where they've got booming revenues, booming cash flows, booming profitability, little debt, and they're buying back stock, making acquisitions, and enacting dividends. There you go. And by the way, the macro driver of gold is so powerful. Why? The Fed's painted themselves in a corner. They got to keep issuing debt. I mean, it's nuts. They can't stop pumping money into the system or we'll have a crash. They know it. And each time they pump more money, the bigger the balloon gets. A balloon eventually gets so taut that it can brush against your carpet and pop. They're doing it, gang. Watch. It's going to be a bloodbath. Am I making you feel good? I believe all this stuff, and I'll do another webinar, and I'll answer any questions, and I'll talk to you personally. All right, what about ETFs? Are those viewed in the same category as mutual funds? Yes, they are. ETFs, you could go for quality ETFs and value. Yes, they are. They're similar. I kind of think active management might outperform the ETFs and the indexes going forward because it's been under active management, which is stock pickers like me, finding companies that are worthless and shorting them and banging on them, or buying something that nobody notices is totally undervalued like gold and getting on that and watching it go up. It's just active management. ETFs are passive. I think active management has a shot here to outperform relative to the history. And so I'm a little bit of a contrarian. There's your answer. I think both are good, but I kind of like mutual fund managers. I think if we do end up with more volatility, they're going to have, I think active management's going to be a little better. Do you like lifestyle mutual funds? If so, I'm 30. What would you recommend? I don't understand a lifestyle mutual fund. I've forgotten. I've heard the term. Be glad to put the Q&A, describe for me what one is, and I'll answer it in a minute. Okay. So whoever asked that, tell me what that is very briefly. Remember, I'm old. And then today, the Senate rejected the second stimulus package for COVID, causing a downturn in the bull market. Do you expect another stimulus package to be approved before the election? Yes, I do. I think that they will do it. Now the Republicans are right to be questioning $3 trillion spending binges. They haven't, do you know they hadn't even spent something like 300 billion of the last one? Just letting you know. They'll misspend this money. Why don't they give me a payroll tax cut? And you and me, we'll get one. The employer and employee. Give me a payroll tax cut holiday. You know what that'll do? It'll incentivize me to work more, not work less. You send me a check, what am I going to do? What will Joe Sixpack do when he gets free money? Work less. It's a disincentive. We went over that. So I understand the Republicans' reticence to just throw money out. And I'm not, and I don't, honestly, I wish they wouldn't do it, frankly. I'm into the payroll tax cut because it incentivizes work effort. It doesn't penalize work. You got to have work to have production, to have GDP, to have tax revenues, to pay for the binges out of Washington. Am I yelling enough? Now, I never heard, whoever the question was about lifestyle investing, please come back to me. Here's another one. Any suggestion on investing in dividend stocks? There's tons of dividend stocks out there, lots of them. And some of the dividends are high. You know what? Ryman Auditorium, RHP. When the COVID crisis blows over, which by the way, I'll tell you right now is overdone. It's overdone, overhyped. They responded poorly. They shut down the economy just because of a small cohort of people that are at risk, including those with cardiopulmonary disease and diabetes that are overweight and hypertension. That's it. And over 80. And for that cohort, which you can isolate and protect, they penalized you and me. And now the Fed has to make up for it through a bloated balance sheet. They set into motion at a time we couldn't afford it, a set of policies that could lead to hyperinflation and so forth. Back to the question. I get all excited. Did you notice any dividend stocks? RHP, Ryman. I like that company. Not a lot of debt, great assets. Nashville's on fire. It'll continue to be on fire, and it has a fat dividend. Yes, they're great companies out with dividends. There's your answer. I love them. I like them because nobody else does. I like them because I can't justify buying Apple here. And then finally, where do you get your news on a daily, weekly basis? Well, I love the Wall Street Journal. I'm totally focused on it. And then there's a cool thing called the Daily Shot. Used to be a product of the Wall Street Journal, but now it's on its own. You got to have like $100, 130 maybe. If you have that to spend in a year, they send you a daily array of charts that are stuff that I look at and think about. It's the neatest tool I got. It's charts, not words. Every day something to think about, something to help you invest, something to help you understand the macro and economics and policy, all of it. I love that. And then I set up news alerts, Google News alerts using keywords. Let's say I'm interested in Ryman Auditorium, Ryman Hospitality. So let's say it might be, what is it? One of their properties, the Opryland. I could do Opryland occupation. No, Opryland, anything about it, I can get it. So let me give you a better example. I'm interested in Brazil, by the way. Emerging markets are also an interesting play here with the dollar falling. Their currencies move up against the dollar. The dollar will fall from dilution, from the Fed printing. It's happening now, by the way. Go look at the dollar chart versus the euro, the yen, or a broad basket of currencies. Again, on barchart.com, currencies. You can look at commodities and currencies and stocks. I love this free program. So you see the dollar falling, emerging markets, and I love Brazil. Brazil just enacted a painful but beautiful reform of their social security system where ours is going bankrupt. I went through that early. They've actually raised their retirement age, cut the juicy retirement benefits to their public servants, a la politicians, even military personnel, bravely cut those benefits and have changed the actuarial table and saved the country. They are also getting ready to privatize companies, cut tax rates. Brazil could be like the place to invest. And I love it. I don't even know how I got off on that. Weekly news. So I use news alerts to say Brazil, like President Jair Bolsonaro is the president's name. Jair Bolsonaro tax cuts. Or Sergio Moro, who is their incredible University of Chicago educated head of their economic minister, chief economic minister, the man who's basically conducting all the economic policy. Paolo Getty's tax cuts. And then every day I get fed information on that topic free, twice a day actually from Google Alerts. Do that with anything you care about and you'll get the free information. Now you have to spend some time to go through it. That's true. Okay, gang, I got one more question, I think. I think you've been, thank you for attending. I hope it was helpful. I hope you're enjoying it. Lifestyle funds, Fidelity Freedom Index, Target Year Retirement Fund. Oh, I like those. Target Year Retirement Funds are pretty good. The fees are high. I think the fees are high, but I think they're clever. I like them. So the lifestyle funds, yeah. Basically, you can target a retirement age and basically set up your whole savings and hopefully appreciation plan based on, sorry, I got an update on my fund today did well. It's down only slightly and the S&P's down 1.2% and I'm not down. Why? I'm shorting in high precious metals. I've hedged. hedge my risk through those two. Look, you're all friends of my kids. I love you like you're my kids. And I hope this was fun for you and I can share my, experience and observations. I will do another, keep a lookout. If I can be of service to you or your family in any way, let me know. And I hope you like the Cameroons. We played the first time in 8 months this weekend in Maine, this last weekend in Maine. We hadn't played since January 1, New Year's Eve. I played with Joe Andrews of Oak Crow Medicine Show. So if we get to play again, I hope to see you at a gig at Brown's Diner. I'm going to say goodbye. You're the best. And have a great day. And again, come to us for questions or facts. Bye.